What if we woke up one day and our house value had dropped by 15% overnight? Imagine. You're sipping your morning coffee, scrolling through the news, and there it is. A headline that sends shivers down your spine. The unthinkable reality that Fitch's report suggests may not be far off. The report points to an increased likelihood of a severe housing downturn, potentially leading to a 15% decline in U.S. home prices. But what could cause such a drastic shift? There are several key factors at play here. Consumer confidence, a vital ingredient in the health of the housing market, has shown signs of decline. As consumers become more cautious, their willingness to invest in homes could wane, driving down demand and consequently, prices. Next, we have GDP growth. This economic indicator has a direct impact on housing. When the economy is booming, people have more disposable income, they're more likely to buy houses and prices are more likely to rise. But when GDP growth slows, the opposite can occur, leading to a drop in home prices. Lastly, we can't ignore the role of unemployment. If people don't have jobs, they can't afford to buy homes. Rising unemployment rates could therefore also contribute to a decrease in home prices. It's important to remember that these are not just abstract figures or hypotheticals. These are the real-world factors that could lead to a significant drop in the value of the house you live in, the house you've invested in, the house you call home. It's a sobering thought, isn't it? But it's not meant to scare or discourage you. Instead, it's a call to awareness, an invitation to understand the forces that shape our housing market, and thus, our lives. Because, as Fitch's report suggests, a significant market deterioration could result in a 30% or more drop in housing activity over several years, accompanied by a 10% to 15% decrease in home prices. This is not just a nightmare scenario, but a potential reality we must prepare for. We're not powerless in the face of these potential market shifts. By understanding the factors at play, we can make informed decisions about our homes, our investments, and our futures. The ticking time bomb beneath the housing market is not a secret, it's the rising interest rates. Now, let's take a trip down memory lane. It's July 2022. A typical summer month, but not for the housing market. Mortgage rates, as if on a caffeine high, doubled compared to the previous year. This sudden leap became a heavy burden for many homeowners and potential buyers. Why, you ask? Well, higher mortgage rates mean higher monthly payments. This can make owning a home less affordable, especially for first-time buyers or those with tight budgets. And when homes become less affordable, demand starts to wane. But it doesn't stop there. As demand decreases, home prices start to fall. This can be a tough pill to swallow for existing homeowners who suddenly find their homes worth less than they paid for them. It's a bit like buying a new car, driving it off the lot, and then finding out it's now worth 20% less. Now let's fast forward to the present. Continued rising interest rates have left many questioning the value of homeownership. Homes are increasingly perceived as overvalued. Think about it. Would you pay top dollar for a house if you knew its price was likely to fall soon? This perception of overvaluation can further dampen demand. After all, why rush to buy something today if it might be cheaper tomorrow? And as demand dwindles, the pressure on home prices continues to mount. We're at a critical juncture. The housing market is like a soda can that's been shaken up. The pressure is building, and it's only a matter of time before the top pops off. The pressure is building, and the housing market is sitting on a bubble ready to burst. When the housing market crashes, it doesn't just affect homeowners, it triggers a domino effect. Imagine this. A significant market deterioration leads to a staggering 30% or more drop in housing activity over several years. Now let's break down what this could mean. For starters, it's not just about the houses that aren't selling, it's about the home builders, the architects, the real estate agents, the mortgage lenders, and all the other jobs tied to the housing industry. These people rely on a healthy housing market for their livelihoods. When the market takes a hit, so do they. But it doesn't stop there. A housing market crash can also force home builders to issue debt to rebuild their inventory positions. Why? Well, think of it like this. If you're a home builder, and you've just invested a significant amount of money into constructing homes that are now sitting unsold, you're in a tough spot. You've got bills to pay, employees to pay, but no revenue coming in. So you might have to borrow money to keep your business afloat. This debt can be a double-edged sword. On one hand, it can help home builders stay in business during tough times. On the other hand, if the market doesn't recover quickly, they could find themselves saddled with debt they can't repay. And if home builders start defaulting on their loans, it could lead to even more economic instability. Now let's zoom out a bit. The housing industry doesn't exist in a vacuum. It's linked to many other sectors of the economy. When people buy homes, they also buy furniture, appliances, and home improvement goods. They hire contractors for renovations. They pay property taxes that fund local schools and public services. So, when the housing market crashes, it's not just the housing industry that suffers, it's the furniture stores, the appliance manufacturers, the contractors, and the public schools. It's a ripple effect that can reach every corner of the economy. The ripple effect of a housing crash is far-reaching, affecting industries and jobs nationwide. The warning signs are all around us, and yet, we choose to ignore them. Renowned economist David Rosenberg has painted a rather grim picture of the near future, predicting a significant economic downturn that could lead to a 25% or more crash in the S&P 500. This is not a small figure, folks. It's a quarter of the market's value, potentially wiped out. Think about that for a moment. Rosenberg's warning signs aren't limited to just the stock market. He's also sounding the alarm about what he calls a looming consumer recession. And what's causing this? The answer is threefold. Firstly, dwindling savings. With inflation on the rise and wages not keeping pace, more and more people are dipping into their savings to make ends meet. This is not sustainable in the long run, and it's leaving a lot of people financially vulnerable. Secondly, student debt payments are resuming. Remember, millions of Americans had their student loan payments paused during the pandemic. With these payments starting up again, that's a significant chunk of change that's suddenly going out the door every month. And thirdly, there are increasing signs of financial stress. We're seeing this in the form of rising unemployment and slowing wage growth. The ripples of these challenges are being felt far and wide, from the dinner table to the housing market. David Rosenberg's predictions aren't to be taken lightly. This is a man who has his finger on the pulse of the economy. He's noticed the warning signs, and he's urging us to pay attention. So what does this mean for homeowners and potential homeowners? It means that the housing market might not be as healthy as it seems. High prices are being driven by limited supply rather than robust demand. This imbalance could lead to a sharp market correction. The storm is brewing, and the time to take cover is now. The aftermath of a housing market crash is a middle-class American nightmare. Imagine, if you will, the consequences of a housing market crash. It's not just about plunging property values or the sudden evaporation of wealth. It's about the ripple effects that such a crash would send through every corner of the economy and society. For starters, we'd likely see a surge in unemployment. As the housing market contracts, so too would the construction industry, the real estate sector, and all the other industries that depend on a robust housing market. Thousands, perhaps millions of people could find themselves out of work, their livelihoods disappearing as quickly as the equity in their homes. And as unemployment rises, wage growth would likely slow. This one-two punch of job losses and stagnant wages would squeeze middle-class families from both ends. It would become harder to make ends meet, harder to save for the future, harder to hold on to the American dream. But the effects wouldn't stop there. A housing market crash could also lead to increased financial stress for many families. As home values fall, homeowners might find themselves owing more on their mortgages than their homes are worth. This could lead to a wave of defaults and foreclosures, further depressing home prices and exacerbating the economic downturn. The long-term effects on the economy could be even more profound. Reduced consumer spending, lower investment, and a loss of confidence in the market could all contribute to a protracted economic slump. This could stifle growth and innovation, leaving us stuck in a low-growth trap for years to come. And the social consequences could be just as dire. A housing market crash could widen the wealth gap, exacerbate income inequality, and deepen the divides in our society. It could undermine the stability of our communities, strain our social safety nets, and challenge our fundamental notions of fairness and opportunity. A housing market crash is not just a financial crisis, it's a social crisis. History is the best teacher, and the lessons it has taught us about housing market crashes are invaluable. In the grand tapestry of time, there have been periods of turbulence that have tested the resilience of the housing market. Each of these instances has left behind a roadmap, a guide to navigating the stormy seas of economic distress. One such potent lesson was the financial crisis of 2008, a crisis that began in the housing market and snowballed into a global economic catastrophe. The 2008 crisis highlighted the perils of unchecked speculation and the importance of responsible lending. It taught us the dangers of assuming that what goes up will continue to rise indefinitely. This assumption led to an inflated housing bubble that inevitably burst, leaving millions in financial ruin. The echoes of this crisis are still felt today, a stark reminder of the consequences of complacency and reckless financial behavior. So, what does this teach us about the potential housing crash in 2024? It underscores the importance of vigilance. We must be acutely aware of the warning signs, the tremors that precede the earthquake. Factors such as consumer confidence, GDP growth, home prices, and unemployment all play a critical role in determining the health of the housing market. Moreover, these lessons underline the significance of preparedness. It's crucial to have a plan for navigating market volatility. This could mean diversifying investments, maintaining a healthy emergency fund, or simply being mentally prepared for a potential downturn. It's also essential to remember that every cloud has a silver lining. History has shown that after every crash, there has been a period of recovery. The housing market, like any other market, is cyclical. There are periods of growth and periods of contraction. Understanding this can help weather the storm and even find opportunities in the chaos. The lessons from past housing market crashes are not just about fear and caution. They are about resilience, adaptability, and the indomitable spirit of the human race to bounce back from adversity. To avoid the nightmare, we must heed the warnings and learn from the past. The prospect of a housing market crash is daunting, but it's not the end of the world. It's a reminder that the only constant in life is change, and with change comes opportunity. So let's explore some strategies that can help us navigate these choppy waters. Firstly, we have to think about diversifying our investments. Putting all eggs in one basket, especially the housing market basket, could lead to a significant loss of wealth in a downturn. Consider spreading your investments across various sectors, including stocks, bonds, and even international markets. This way, if one sector plummets, others may perform well, providing a financial safety net. Secondly, it's crucial to maintain a robust financial plan. This plan should be tailored to your individual needs, risk tolerance, and long-term goals. It should factor in potential market crashes and economic downturns. Remember, a well-structured financial plan isn't just about wealth accumulation, it's also about wealth preservation. Next, keep a long-term perspective. The housing market, like any other market, has its ups and downs. If history has taught us anything, it's that markets recover over time. Even in the face of a crash, it's important not to panic sell. Instead, hold on to your assets and wait for the market to rebound. Knowledge is power, and staying informed about market trends, economic indicators, and financial news is critical. The more you know, the better equipped you'll be to make well-informed decisions. Don't rely solely on headlines or sensational news stories. Dig deeper, understand the factors driving market changes, and consult with financial advisors, economists, and industry experts. Lastly, remember that everyone's financial situation is unique. What works for one person may not work for another. It's essential to assess your own financial health, determine your risk tolerance, and make decisions that align with your personal and financial goals. The future may be uncertain, but with preparation and resilience, we can weather any storm. Remember, the key to navigating a housing market crash, or any financial challenge for that matter, is not just about surviving, but thriving. It's about turning challenges into opportunities and emerging stronger on the other side.